Hello, everybody. So I've covered strategy a lot of the past few days. I want to take a minute to talk about other stocks that I'm tracking. Three stocks I'm going to discuss today: Oddity, ON Holdings, and Root Insurance. And I'm also going to show you three more stocks as a bonus at the end of the video. So let's get started. Let's talk about Root. Root is a stock that is now cheaper than when I last covered it. When I covered this stock first, it was trading at $120. Root, and I still agree with what I said the last time, is kind of my favorite insurance play. I prefer Root over Lemonade. They only do car insurance, or mostly, correct me if I'm wrong. I mean, I know their vision is to do more than just car insurance, but from my understanding, they mostly do car insurance. And they've been able to grow very, very fast, having an AI-enabled all app-based interface of onboarding people, kind of like using mobile to onboard people to car insurance. You can see the CAGR of the premiums written, which is their revenue. That CAGR is 45%. They've grown consistently at 45%. The last report, I actually saw something like 61% growth in premiums written. Analysts are saying they're going to grow their premiums by 53% over the next 12 months. This stock was stuck in a valley of despair for more than 2 years, and it started running back up in the early 2024s, but we haven't really moved since April of 2024. We used to be much more expensive at the beginning of 2025. The stock has kind of sold off. And what's very interesting about this stock, of course, is they use AI to give better premium, to assess risks better. They let you use your phone and drive with your phone on so that they know how well you're driving. But what's really innovative, in my view, is the way they are selling. They are selling a lot of insurance policies via dealers, via online dealers, and via Carvana. You can see they're embedded within Carvana, and you do Carvana insurance, fulfilled by Root, provided by Root. And so they have a lot of B2B partnerships that allow them to grow their insurance business pretty fast. They also grow through insurance marketplaces, etc. They have a partnership with local insurance agents. They have a lot of things going on. And they're growing very fast. And more importantly, they fit my numbers. What are my numbers? Is I'm looking for a company that grows quite fast, that has high gross margin, that has high EBITDA margin, that has a rule of 40 of above 40, and that is cheap. And the Root kind of fits all four of them. It occurs to me I forgot to tell you about my top line. So what do I look in a stock in general? I want to see top line growth above 30%, in the 30-ish% range. I want to see EBITDA profitability. I don't want to see my stock lose money. Why do I use EBITDA? Because EBITDA is a proxy for cash flow. The higher the EBITDA profitability, the better it is. I want a rule of 40 because there's plenty of studies that show that when stocks have a rule of 40 or more that they achieve, which is growth rate plus cash flow margin, when you add those up, if you get more than 40, typically you outperform, and that's something that VCs used to use. Now I like to use it for a lot of stocks. I want to have a super low enterprise value over gross profit over revenue growth. This is exactly what I have here at a 0.04. The reason why I use gross profit, of course, and I've said that before in the early days of the channel, why do I use gross profit and not net profit or operating profit? It's because in the modern corporation, a lot of the expenses that you spend after gross profit are actually investment. For example, if Root invests a bunch of money in marketing, traditional accounting views that as an expense. I tend to view that as an investment. And it's kind of Amazon who pioneered that and looking at really a lot of the expenses past gross profit as investment. So that's why I prefer to compare firm from gross profit to gross profit. Another advantage when you use gross profit is that the firms don't tend to differ as much on gross profit. They differ much more when you start using things like operating profit. Another thing that I really look for in a stock is to have a diversified customer base. Look at that more and more, especially as, I do a lot of biotech stocks, but sometimes a decision from the government, from Medicare, for example, can entirely kill a business. I like to have a diversified customer base where you have thousands, hopefully millions, depending on the product, millions of individual customers who make millions of decisions to create that bottom line, because when you have companies that say use, for example, government reimbursements, you can have a simple government change and then the company can lose most of its revenue, right? It happened to solar, it happened to a lot of Medicare companies, like I said. So I like to have a diversified customer base for my top line. I want a diversified customer base. So anyways, Root fits that. I want to talk about another stock, the Nike Challenger. At least that's how I call it. It's On Holdings. So On Holdings was ramping up quite a bit, had a little bit of buzz with the Olympics. It was pretty much more expensive than what it is right now for the past 18 months or something like that. This stock is kind of forgotten by the market. It's cheaper than the last time I covered it in early 24. This stock has a dual share trust structure, which makes it founder-led and founder-led for a very long time. It's a mission-driven company based in Switzerland. Their stores make a lot of money. Each of their stores are high-volume stores. These running shoes are pretty expensive. They're more expensive than Nike, which means that you have pretty good gross margin, 61%. It's an expensive product, and people like the product, and people spend a lot of money on that product. Of course, I don't necessarily want to be in the running shoes business. I don't really care, but I want to be in the business of owning a high growth stock that is cheap. ONON fits that. It's a cultural consumer phenomenon. I see people wear those shoes all the time. Okay, they're expensive shoes, and the company is still growing very fast. Growing revenue, 32%. Predicted to grow next 12 months. Gross margin very high at 61%. EBITDA margin is 12%, right? What are we trading at on enterprise value over gross profit over revenue growth? It's a 0.2. It is much cheaper than Nike. The rule of 40 is there at 44 for a stock that works in the consumer goods business. I actually making this video compared to a lot of other consumer goods companies like Lululemon, for example. A lot of people love Lululemon right now. Yeah, it doesn't score nearly as well as this. Nike doesn't score nearly as well on this. This stock, kind of forgotten right now. I'm monitoring it. And both of these stocks, by the way, whether it's On Holdings or Root, if they miss their earnings, that would be an opportunity for me to add. That's kind of how I'm approaching November and the earnings season, is that if a stock misses their earnings for no reason, that could be an opportunity for me to add. So I like these two very much. The third one, and of course this one I own, so I own Oddity. I like Oddity very much. Oddity is cheaper than Elf. A lot of people online like Elf. The problem with me is that, Elf makes a lot of money at Target. Target's not doing well. Elf makes a lot of money in retail situations where they have to share the revenue. Odd doesn't have any such problem. Odd sells direct to consumer online. Odd is a company that reminds me of Hims, but for beauty. It's the Hims of beauty. It's kind of how I look at odds. They have two products which eventually will be billion-dollar brands. One of them is called Il Maquillage, and another one is called Spoiled Child. One is a skincare brand. Another one is a foundation brand. And the reason why I say that this has recurring-like revenue is because, for example, with the brand Il Maquillage, they've been very successful. I repeat myself, but it's essentially an AI questionnaire, and it's the use of AI to match a custom color to a custom skin. And this is solving a long problem in cosmetics of trying to match a makeup to the color of the consumer. And so people, when they find that Il Maquillage works, they just keep buying it. And that's why you have such high recurring revenue. And of course, we have a major catalyst coming for Odd in the second half of this year, within the coming month, right? Before Christmas, we have a catalyst coming up, which is the launch of their medical grade skincare business, the third brand, which they are going to announce, which we know nothing about. This is going to be, in my view, a catalyst for this stock. And this stock has a goal of launching two more brands. So the next one is going to be a skincare brand, and there will be a fourth one that is launched. This stock considers itself to have a competitive advantage in terms of marketing. It's a marketing machine. It's mostly selling the products in the beauty space through social media Anyway, I don't really want to be invested in the beauty space. Like always, I don't really care about what I'm investing in. What I care about is the numbers. And when I look the numbers at when I look at the numbers, I like it very much. Oddity, next 12-month revenue growth predicted to go 26%. Gross margin 72%. Yeah, makeup is highly profitable. EBITDA margin 29%. Enterprise value over gross profit over revenue growth is 0.18. The rule of 40 on this stock is just blowing past 40 out of 55. So I like this stock very much. There's been weakness in this stock recently. I view it as a buying opportunity, although there's a lot of deals out there. The indices are at all-time high. Everybody's talking about S&P breaking an all-time high. But individual stock pickers, there's a lot of deals for stock pickers right now, right? So, but the indices are at all-time high. Okay, I guess. But that doesn't mean that your one stock that you're looking at is at an all-time high. To me, when I look at Odd, I find it cheap right now. And I kind of have 3 bonus stocks that I'm not going to cover in depth in this video, but I covered them before on the channel, except Birna. I'm not going to cover Birna on the channel because of the YouTube rules. But if you look up Birna online, it's like a giant BB gun essentially. So I'm not going to cover Birna on the channel. But gambling.com and REAX.com, these two are very interesting from a valuation standpoint. So REAX, of course, I've covered it. It's my real estate play. I've covered it in a prior video. Gambling.com, very interesting. They own a bunch of websites. They provide data feeds for casinos. They all own all sorts of different websites, kind of benefiting from the legalization of online gambling throughout the United States. This stock has been sold off. Some people are concerned about changes in advertising and how changes in advertising could hurt the various websites of gambling.com. But, I find it very cheap. 0.12, rule of 40 is a 45 for gambling.com. REAX to me is a clear buy in this. I own REAX. It's a 0.1 and a rule of 53. And Birna, I encourage my viewers to look it up. I find this very interesting, highly uncorrelated to anything I own. Absolutely uncorrelated to anything I own. I might cover it on the Patreon again to stay consistent within the YouTube rules. But anyways, these are my 3 bonus stocks. Lots of stocks that are cheap right now. Lots of deals right now besides strategy and besides Bitcoin. So hopefully that gives you an idea of what I'm looking at for those of you who have been waiting for the non-strategy videos. So anyways, this was not investment advice, not financial advice. This is only entertainment. I'm hoping you were entertained. Please like, please subscribe, follow me on Patreon. Follow me on X. Thank you for watching and have a wonderful, wonderful day.